There's a money myth so common that people will literally turn down a raise because of it. Maybe you've heard it. Maybe you've said it. It goes like this. Be careful taking that raise. It could bump you into a higher tax bracket, and you'll actually end up with less money. Let me say this as plainly as I can. That is false. It does not work that way. It has never worked that way. And believing it is quietly costing people promotions, overtime, and bonuses they were afraid to accept. The fear feels logical. You imagine crossing some invisible line, and suddenly your entire income gets taxed at a brutal new rate. But that's not how the system is built. A raise can never, not under any normal circumstance, leave you with less take-home pay than before. So today we're going to fix this misunderstanding for good. In 5 simple steps, I'll show you exactly how tax brackets really work, why a raise always puts more money in your pocket, why your real tax rate is lower than you think, and the legal levers you can pull to actually shrink your bill. By the end, you'll understand your own paycheck better than most people ever will. Here's the single idea that unlocks everything. Tax brackets are marginal, and marginal just means the higher rate only applies to the dollars above a line, not to all of your income. Picture your income as a tall glass being filled from the bottom up. The first layer of dollars gets taxed at the lowest rate, say 10%. The next layer up gets taxed a little more, maybe 12%. The layer above that, 22%. And so on. The crucial part, when your income rises into that 22% layer, only the dollars sitting in that layer pay 22%. Every dollar below it keeps its original lower rate. The bottom of the glass is never re-taxed at the top rate. So when someone says, "I'm in the 22% bracket," that does not mean 22% of everything they earn. It means 22% is the rate on their last highest dollars. The dollars underneath are still happily paying 10 and 12. There is no cliff. There is no line you cross where your whole income suddenly gets punished. It's layers, each with its own price tag, stacked calmly on top of each other. Once you can picture that glass, the rest of how taxes work stops being scary and starts making sense. Now, let's take that myth out behind the building and end it once and for all. Say you're earning a salary that puts your top dollars in the 12% layer, and you get a raise that pushes some of your new income up into the 22% layer. The myth says you'll lose money. So let's actually follow the dollars. Your old income? Taxed exactly as before. Not a penny changes on those dollars. The only thing that gets taxed at the new higher rate is the raise itself. And even then, only the slice of it that pokes into the higher layer. So out of every new dollar that crosses into 22%, you still keep 78 cents. Think about that. 78 cents on the dollar is still more money than zero. The raise is taxed a bit more heavily at the very top, yes. But your take-home pay goes up every single time. It is mathematically impossible for a higher salary to leave you with less in your pocket. So the next time someone warns you about a raise, bumping you up a bracket, you can smile, take the raise, and keep the extra money they were too scared to. This brings us to 2 words that get confused constantly. And the difference is worth real money to understand. Your marginal rate versus your effective rate. Your marginal rate is the rate on your highest dollar, that top bracket we keep mentioning. If your last dollars are taxed at 22%, your marginal rate is 22%. But that is not the rate you actually pay on your income as a whole. Your effective rate is the blended average across all your layers. Remember the glass? Some of your money was taxed at 10%, some at 12%, some at 22%. Average all of that together, weighted by how much sits in each layer, and you get a number that's noticeably lower than your top bracket. So someone in the 22% bracket might actually be paying something like 14% of their total income once you blend it all. Their top rate is 22. Their real rate, the effective one, is far gentler. This matters because people massively overestimate their tax burden. They hear 22% bracket and assume nearly a quarter of everything they earn vanishes. It doesn't. Your effective rate is always lower than your marginal rate. Always. Once you understand that your income is taxed in layers, deductions suddenly get a lot more interesting because of where they take their bite. A deduction lowers your taxable income. The standard deduction is the big one almost everyone takes. It simply shaves a chunk off the top of your income before any tax is calculated. And here's the magic. It removes your highest tax dollars first. Go back to the glass. Your top dollars are sitting in your most expensive layer, the 22% one. A deduction doesn't politely remove dollars from the cheap 10% layer at the bottom. It lifts them straight off the top. So every dollar of deduction saves you tax at your top marginal rate, not your low effective rate. That's why deductions are worth more than they look. A dollar deducted from the 22% layer saves you 22 cents. Far more than that same dollar would have been taxed down in the cheaper layers. So when you hear about the standard deduction, don't picture a small discount. Picture a tool that erases your priciest, most heavily taxed dollars first, quietly trimming the most expensive part of your bill. It's the same logic for any deduction, because they always come off the top of the stack. Their value is set by your top bracket, not your gentle effective rate. The higher your income climbs, the more each deducted dollar is worth to you. So far, this has been about understanding the system. This last step is about working it, legally on purpose, in your favor. Here's the lever you control: pre-tax accounts. When you put money into a traditional 401k, a traditional IRA, or an HSA, that money comes out of your income before tax is calculated. It lowers your taxable income for the year. And remember which dollars get removed: the ones at the very top of your stack. So a pre-tax contribution doesn't just save you a little. It shaves dollars off your highest tax layer, just like a deduction. You're choosing to be taxed less, right now. Picture it as pulling your income column down the stack. Contribute to your 401k, and the top of your income physically drops, out of the more expensive layer and into cheaper territory. Your taxable income falls, and your tax bill this year falls with it. The trade-off, of course, is that retirement money gets taxed later when you withdraw it, though often at a lower rate. But the point stands: you are not a passive victim of your tax bracket. You have a dial. Pre-tax accounts let you turn it down, building your future and cutting today's bill in the same move. So let's pull it all together. Tax brackets are marginal. Your income is taxed in layers, and there is no cliff that punishes your whole paycheck. A raise always nets you more money, because only the new top dollars pay the higher rate. Your effective rate, the blended average you actually pay, is always lower than the top bracket everyone obsesses over. Deductions shave off your most expensive, highest tax dollars first, which is why they're worth more than they look. And pre-tax accounts let you choose to lower your taxable income now, dropping yourself down the stack on purpose. Put simply, the system is far less scary and far more in your control than the myths suggest. Understanding it means you'll never again leave money on the table out of fear, and you'll know exactly which levers to pull to keep more of what you earn. If this finally made tax brackets click and saved you from ever fearing a raise again, hit subscribe. That's what this channel is for. The money stuff nobody ever bothered to explain. Next, why your tax refund isn't free money. It's your own paycheck on a 0% loan to the government. I'll see you there.